Our next question comes from Advait Prasad in New York. He writes, Berkshire's sitting on over $300 billion in cash and short-term securities. That's about 27% of total assets, far above the roughly 13% average of the last quarter century. In fact, the company now effectively holds nearly 5% of the entire U.S. Treasury market. Beyond meeting insurance liquidity needs, is this buildup mostly a way to reduce risk in light of high valuations, or is it also meant to give Greg Abel more flexibility during the leadership transition, setting him up with a clean slate for future capital decisions? And I'll tack on a line from another shareholder, Mike Conway, who asks, do you think you'll see some nice fat pitches coming your way soon? Well, I wouldn't do anything quite so noble as keeping money on the sidelines just to make Greg look smart later. If he ends up getting a head start because of me, I might even be a little jealous. Now, about that mountain of cash. We've come close to spending big before. Not too long ago, we nearly wrote a check for around $10 billion. And if the right thing showed up tomorrow, I'd be happy to put $100 billion to work. These aren't agonizing choices. When an opportunity comes along that makes sense, one we understand, one that offers real value without keeping us up at night, we move. The tricky part is such chances don't show up neatly spaced on a calendar. They never have, and they never will. If investing worked like clockwork, say 4 great deals every trading day, life would be simple. But it doesn't. Over roughly 80 years, I've seen about 16,000 trading days. They don't all bring you something worth swinging at. This isn't a numbers racket where the odds reset evenly each day and you just count the handle. We're in a business that's completely opportunistic. Charlie always felt I took too many swings. He used to say, if we'd only done 5 really good deals in our lives instead of 50 decent ones, we'd have done even better. And maybe he was right. We'd love it if conditions allowed us to hold, say, $50 billion in treasuries instead of $135 billion. But the world doesn't hand out bargains on demand. We've actually made a lot of money by being comfortable not being fully invested all the time. That patience has paid off. There's nothing wrong with ordinary investors buying a few sound businesses and holding them forever. But we made a different choice. We decided to be in the game. That means we try to do better by acting irregularly, not mechanically. If someone told me I had to invest $50 billion every single year until the cash pile was down to $50 billion, that would be about the dumbest rule imaginable. Great opportunities come rarely. The long-term trend of markets is up, but timing? Nobody knows. Not me, not Greg, not Ajit, not anyone. Nobody can tell you what the market or the economy will do tomorrow, next week, or next month. People talk endlessly about it because it's easy to sound smart, but it's never been useful. I've never met anyone worth listening to on that topic. On the other hand, what is worthwhile is turning pages. Literally, going through reports, annual statements, those thick Japanese manuals I used to love even when I couldn't read half of them. That's a treasure hunt. Every now and then, you uncover something special. It doesn't happen often, but it will happen again. I don't know when, maybe next week, maybe 5 years from now, but not 50. Sooner or later, we'll be flooded with chances we're happy to have cash for. It'd be more fun if that happened tomorrow, but odds are it won't. The odds get better the longer you wait, sort of like life expectancy in reverse. When you're 10, the chance of dying tomorrow is tiny. When you're 95, well, it's practically guaranteed. And by the way, women hold all the records for longevity. I once told Charlie he should switch teams and test that theory out. He didn't, but for a man, he still did pretty well.